tax, right? That's what everyone cares about. And so this is a federal study only, not California. I'm just going to focus on the federal side because that's really where the tax cuts kind of kick in. And so I have two case studies. Both these clients were manufacturers. So the first case study, you had a company, $500,000 of income. They got what was called DPAD, Domestic Production Activity Deduction. So case study one, we have a manufacturer making $500,000. DPAD was a deduction created back in 2006 that basically rewarded companies for doing manufacturing in the United States. It was 9%. So they would get that deduction. I had some assumptions that they had wages and other things, so that 660 is not the math. So then we looked at state and property taxes, 70,000. Itemized deductions allowed because they had some other deductions. So at the end of the day, we had taxable income of 585,000. Kind of fast forward to the 2018, we have AGI. So again, it's the 500,000 plus wages and some other assumptions to get to 705. State and local taxes are limited to 10,000. We'll get to that. I'm sure everyone knows that because it was all over the place. So now itemized deductions are going to be limited to 25,000. But this new deduction, QBI, qualified business income, kind of sneaks in there. And basically what that is for manufacturers, distributors, a lot of different type of companies, except for some service providers, because no one likes service providers. They get a 20% deduction. And so you take the 100,000 off and you can see taxable income is pretty close to the same, 585 versus 580. But the tax rates changed as well. And so you look at that scenario, the tax goes from 177 to 154,000 or a 12.7% reduction. Case study two, you have a company making a little bit less, all the same kind of facts. The one big difference on this case is they were being subject to AMT. So AMT is an alternative way of calculating your tax. We calculate it one way, we calculate it the other way, whichever's higher is the one you pay. And a lot of people got subject to that because state and property taxes. So although they lost a big part of their state and property tax deduction, they weren't already getting the benefit fully anyways. So you can see in their case, the tax savings, even though they're making 300,000 less, is almost the same, and it equals up to about a 21%, 22% savings. During tax season, for every client we did a tax return for, we kind of benchmarked, okay, if it was apples to apples, what did your return look like under the new tax reform? It was a common question we had. And I would say 9 out of 10 of our clients were better off, some slightly better, some 20% better, but kind of across the board, outside of some unique situations, everyone was better off. And we're in a state where that was harder to do because we paid high state and property taxes. So some of these deductions didn't impact us as great as they did in some of the other states.